On the morning of Monday, August 5, 2024, the global financial system suffered a massive heart attack. It wasn't a slow decline. It was a violent, sudden seizure that paralyzed trading desks from Tokyo to New York in Japan. The Nikkei 225 index collapsed by 12.4% in a single session. To put that number in perspective, that is worse than the crash of 1929. It is worse than the crash of 2008. It was the largest single-day point drop in the history of the Japanese stock market, erasing all the gains of the entire year in 6 hours. But the earthquake didn't stop in Tokyo. The shockwaves traveled under the ocean via fiber optic cables at the speed of light and hit Wall Street with the force of a tsunami. Before American traders had even poured their morning coffee, the Nasdaq futures had plummeted. The Magnificent Tuju, Apple, Nvidia, Microsoft, the generals of the US economy, lost nearly $1 trillion in market value. Bitcoin, the asset that is supposed to be the safe haven against the banking system, crashed by nearly 20% in minutes, wiping out hundreds of billions of dollars of wealth. The fear gauge, the VIX, exploded from 17 to 65. We have only seen a number that high 2 times in modern history. During the Lehman Brothers collapse in 2008 and during the onset of the pandemic in March 2020, the financial media was screaming, "Is this World War II? Did the US economy collapse overnight? Is this a recession?" If you looked at the NDA headlines, they blamed weak jobs data or AI bubble bursting. But they were wrong. It wasn't war. It wasn't a recession. And it wasn't about it was something much more mechanical. Something invisible to the average person, yet dangerous enough to bankrupt nations. It was the unraveling of the yen carry trade. For 30 years, the world has been addicted to a financial drug. A drug that allowed Wall Street to borrow money for free in Japan and use it to gamble in America. It was the infinite money glitch that artificially inflated your house price, your 401, and the entire global asset bubble. But on August 5th, the Bank of Japan did the unthinkable. They turned off the tap. They raised interest rates by a microscopic amount, 0.25%. 0.25%. And that tiny move was enough to trigger a 20 trillion margin call. We are not just looking at a market correction. We are witnessing the end of a 30-year financial regime. The black Swan has landed and it speaks Japanese. Most people think the danger has passed because the stock market bounced back. They are being lied to. The unwinding is only 50% complete. The whales are still trapped, and the biggest whale of them all is holding a gun to the head of the US Treasury market. Welcome to Finance. Chapter 7. The Infinite Money Glitch Carry Trade Explained, Prism. In this massive deep dive, we are going to expose the mechanics of the machine that just broke. We will explain the currency hedging trap that is forcing Japanese banks to dump US debt. We will look at the ghost of 1998 to see how this story ends. And we will give you the specific barbell strategy that institutional investors are using right now to survive the liquidity drain. This is not a drill. This is the financial history lesson that will save your wealth. To understand this crisis, we have to stop thinking about money as cash and start thinking about it as water, liquidity. Imagine the global economy is a giant system of pipes and tanks. For the last 30 years, Japan has been the great reservoir. It is a massive tank filled with unlimited water, and the most important thing about this water is that it is free. Since the bursting of their own bubble in 1990, Japan has been fighting a brutal economic war against deflation and a shrinking population. To keep their economy alive, the Bank of Japan, their central bank, did something unprecedented. They cut interest rates to 0% for decades. At times, they even went to negative interest rates. This means that if you were a bank or a hedge fund or even a regular person in Japan, you could borrow money for free. There was no cost to borrow. The tap was wide open. Now, imagine you are a hedge fund manager in New York. You see this? Open tap of free money in Tokyo. But across the ocean in the United States, you see a high-yield bucket in America. You can buy US Treasury bonds that pay 5% interest. You can buy Nvidia stock that goes up 100% a year. You can lend money to private equity firms for 10%. So, what do? You build a pipeline. You execute the carry trade. Here mechanism step by step. Step 1. You borrow 100 billion Japanese yen at 0% interest. Step 2. You immediately sell that yen and buy US dollars. Step 3. You take those US dollars and invest them in American assets that pay a yield. Mathematically, you cannot lose. You are borrowing at zero costs and earning 10 or 20% return. It is free money. It is the financial equivalent of perpetual motion. But there was a second layer of profit that made this trade addictive. It was the currency bonus. Because every hedge fund, every bank, and every algorithm in the world was doing this, selling yen to buy dollars. The value of the yen crashed. It fell from 100 yen to the dollar down to 160 yen to the dollar. This meant that the loan you took out in yen kept getting smaller in dollar terms. You borrowed money and the debt literally shrank while you held it. It was a perfect self-reinforcing feedback loop. It pumped up US asset prices to record highs. It kept US interest rates artificially low. It made everyone feel like a genius. Analysts vary on the exact number, but estimates from major banks suggest the total size of this trade, both the lit trade that we can see and the shadow trade hidden in derivatives, is roughly $20 trillion. That is roughly the size of the entire gross domestic product of the United States. This massive ocean of Japanese cash has been propping up asset prices all over the world. It is the invisible liquidity that has made you feel richer. But sir, Chapter 2. The Widowmaker Why Japan Pulled the Plug is one rule in finance that never changes. There is no such thing as free money. There is always a cost. And the cost of the carry trade is currency risk. You are betting that the yen will stay weak forever. You are betting that the Bank of Japan will never fight back. But on July 31st, 2024, the Bank of Japan fought back and the trap snapped shut. For decades, betting against the Bank of Japan was known as the Widowmaker trade. Traders who bet that Japanese interest rates would rise lost everything. The Bank of Japan was committed to zero rates with religious seal. So why did they change? Why did they pull the plug in 2024? Did they want to destroy the US economy? No more. They did it because they were dying. For 30 years, Japan exported deflation. They kept their currency cheap to help their exporters like Toyota and Sony. But in 2022, the global inflation wave hit Japan's shores. Because the yen was so weak, trading at 38-year lows, the cost of energy and food exploded. Japan imports almost all its oil, and a huge amount of its food. Regular Japanese citizens were being crushed. Their wages were stagnant, but the price of rice, electricity, and gasoline was soaring. The weakened policy, which was designed to help Wall Street and corporations, was destroying the middle class. The approval rating of the Japanese government collapsed. The public anger was palpable. The Bank of Japan, led by Governor Kazuo Ue, faced an impossible choice. Option A. Keep rates at 0 to protect the global carry trade and keep the U.S. stock market happy. Result: the yen collapses to 170 or 182, the dollar triggering hyperinflation in Japan and destroying the livelihood of their own people. Option B. Raise rates to defend the yen and lower the cost of living for their citizens. Result: blow up the global carry trade and risk crashing the financial system. They chose their own people. On July 31st, they raised rates to 0.25% and announced they would cut their bond buy-in program. It was a declaration of independence from Wall Street, and here is the crucial part that the media is missing. They are not done. Governor Ue has explicitly stated that if inflation continues, they will continue to hike rates. They are targeting a neutral rate of 1% or higher. If a hike to 0.25% caused a global panic. What do you think? A hike to 1% will do every single basis point increase in Japanese rates narrow the gap between the US and Japan. Every step narrows the profit margin of the carry trade, and every step forces more capital to flow back to Tokyo. This is the great repatriation. It is the sound of 3 decades of liquidity being sucked out of the US and Europe and returning to its source. Chapter 3. The mechanics of the crash global margin call. Let's look at the math of what happened on that fateful week in August, because this is where the black swan reveals its teeth. When the Bank of Japan raised rates, the yen strength, it went up. And this triggered the nightmare scenario for every hedge fund manager in New York and London. Let's go back to our analogy. You borrowed 100 million yen when the exchange rate was 160 yen to the dollar. That loan was worth about $625,000. You converted it to dollars and bought US stocks. Suddenly, the yen rises by 10% against the dollar. It goes to 140. Now, to pay back that same 100 million yen loan, you don't need $625,000 anymore. You need over $714,000. Your debt just increased by nearly $90,000 overnight purely because of the exchange rate. You haven't done anything wrong. Your stocks might even be up, but your debt is exploding faster than your assets. This triggers the margin call. The bank calls you and says, "You are underwater. Underwater. Pay us back now." But you don't have the cash. Your cash is fully invested. It is in Nvidia. It is in Microsoft. It is in Bitcoin. It is in us. Treasury bonds. So, what do? You sell. You don't sell Nvidia because you think Nvidia is a bad company. You sell Nvidia because it is the only thing you can time sell to get the cash to pay back the yen loan. This is called forced selling, and it is price agnostic. They hit the sell button at any price. This explains why on August 5th, everything crashed at once. Gold crashed. Silver crashed. Crypto crashed. Stocks crashed. Even bonds wobbled. In a normal market, when stocks go down, safe. Assets like gold usually go up. But in a liquidity crisis, in a margin call, correlations go to 1. Everything gets sold to raise cash. This is the mechanism that terrified the markets. It wasn't about the US economy. It was about the plumbing of the financial system. The leverage was unwinding. The 20 trillion balloon was Now, the mainstream media told you that the crash is over. The market bounced back. They said the carry trade unwind is mostly done. This is the most dangerous lie being told right now. According to analysts at JP Morgan and other major firms, only about 50 to 60% of the carry trade has been unwound. That means there are still trillions of dollars of leverage bets sitting out there, waiting for the next spike in the yen to blow up. And the biggest player in this game isn't a hedge fund. It is a force of nature known as the Japanese banking system, and specifically a whale named Norinu. Chapter 4. The Clowell Norinchukin Bank Crisis. You have probably never heard of the Norinchukin Bank, but they are one of the most important financial institutions in the world. They are the central bank for Japan's agricultural cooperatives. They manage the savings of millions of Japanese farmers and fishermen. They hold over $400 billion in assets, and for years they have been known on Wall Street by a specific nickname, the CLLO whale. CLLOs are collateralized loan obligations. They are bundles of risky corporate loans. Because interest rates in Japan were zero, Norinchukin was desperate for yield, so they took their depositors' money, the farmers' money, and bought hundreds of billions of dollars of these risky American and European debt bundles. Their investment portfolio was massive. But here is the catch. When a Japanese bank buys US bonds, they have to hedge the currency risk. They have to buy insurance in case the dollar falls against the yen. Normally, this hedge costs very little. But as the US Federal Reserve raised interest rates to 5%, the cost of this currency hedge exploded. It became so expensive to hedge the dollar that it ate up all the profits from the bonds. Norinchukin was losing money just to hold the bonds. In June 2024, just weeks before the crash, Norinchukin dropped a bombshell. They announced they were projecting losses of 1.5 trillion yen, about 12 billion for the fiscal year Y, because of the hedging costs. So, they did the only thing they could do. They announced a massive fire sale. They stated they would sell $63 billion of US and European sovereign bonds. Think about the implications of this. This is not a speculator betting on a stock. This is a conservative Japanese bank dumping $63 billion of Western debt. When a whale like Norinchukin sells, it drains liquidity from the market. It pushes bond prices down and yields up. This is the credit event that no one is talking about. If Japanese banks are forced to sell their US assets to cover losses at home, it creates a doom loop. Selling drives down prices. Lower prices cause more losses for other banks. More losses cause more selling. Norinchukin is the canary in the coal mine. If the Clowell is bleeding, the entire ocean is unsafe. To understand how dangerous this unwinding can be, we don't have to. Chapter 5. The Ghost of 1998 LTCM History Repeats. Guess we just have to look at history. We have seen this exact movie before. The year was 1998. There was a hedge fund called Long-Term Capital Management, or LTCM. It was run by the dream team of finance, Nobel Prize-winning economists, and legendary traders from Salomon Brothers. They had a computer model that they claimed could not fail. Their strategy, the carry trade, they borrowed cheap money in Japan and Europe to buy higher yielding bonds in Russia and other emerging markets. They were leveraged 100 to 1. They owned over $1 trillion in exposure with only $4 billion in equity. They were picking up pennies in front of a steamroller, and in August 1998, the steamroller hit them. Russia defaulted. On its death, the flight to safety began. Investors rushed out of risky assets and bought the safest asset they could find, the Japanese yen. The yen exploded in value in just 3 days. In October 1998, the yen rose by more than 13% against dead dollar for LTCM. This was the apocalypse. Der debt engine. Yen exploded in value, while their assets in Russia went to zero. The math broke. The Federal Reserve had to step in. They organized a massive bailout of 14 banks to prevent LTCM from taking down the entire global financial system. Why am I telling you this? Because the leverage in the system today is exponentially higher than it was in 1998. LTCM was one fund. Today, the carry trade is the entire market. It is every macro hedge fund. It is every algorithm. It is every pension fund chasing yield. We are currently watching a slow motion replay of 1998, but on a scale that is terrifyingly larger. The yen spike we saw on August 5th was just the first. Tremor, if the yen strengthens to 130 or 120 against the dollar, the losses will be in the trillions, not billions. And the Federal Reserve might not have enough ammo to bail everyone out this time. Now, let's address the crypto crash. Why? Chapter 6. The crypto link Bitcoin as liquidity sponge. Did Bitcoin, the anti-system asset, crash harder than the system itself on August 8? Why did it fall nearly 20%, while the S&P fell 4%? Because Bitcoin right now is functioning as the world's most sensitive liquidity sponge. According to macro analysts, Bitcoin has a correlation of roughly 0.94 with global M2 money supply. That is an incredibly high correlation. It means Bitcoin moves almost in lockstep with the amount of liquidity, cash, and credit in the global system. In the era of the carry trade, hedge funds used cheap yen not just to buy safe bonds, but to buy the most volatile, highest beta assets they could find. They borrowed yen to buy crypto. This is why Bitcoin and the Nasdaq have been moving in lockstep for 3 years. They are both driven by the same liquidity cycle. When the yen spiked and the margin calls went out, traders had to sell their most liquid, profitable assets first. The crypto market never sleeps. It trades 24/7. So when the panic hit Tokyo on Sunday night, the US stock market was closed. The bond market was closed. But the crypto market was open. Bitcoin became the eighth for the global margin call. Traders sold Bitcoin to raise the cash they needed to pay back their yen loans before the stock market opened on Monday morning. They weren't selling because they lost faith in Bitcoin technology. They were selling because they needed liquidity. This proves that Bitcoin is currently trading as a risk-on asset. It is the canary in the coal mine. If you want to know if the carry trade unwind is over, don't look at the Dow Jones. Look at Bitcoin. Look at the US DJPY chart. If the yen strengthens and Bitcoin dumps, the unwind is still happening. The net liquidity equation is the only thing that matters for crypto price action in the short term. However, this short-term pain sets up the long-term bullish case. Because if the system breaks, if the unwinding causes a credit freeze, the central banks will have to respond. Andy, their response is the rocket fuel for hard assets. So, how does this end? Jerome Powell and Chapter 7, the endgame yield curve control. The Federal Reserve are now trapped in a box. They wanted to keep interest rates high to fight inflation in the US, but high US rates are exactly what is breaking the yen. The gap between the US 5.5% and Japan 0.25% is too wide. The pressure is too high. If the Fed keeps rates high, the yen carry trade continues to explode. Japan keeps selling US bonds. US bond yields spike. Mortgage rates hits 8%. The USB banking system, which is sitting on hundreds of billions of unrealized losses on bonds, starts to collapse. We get a financial crisis worse than 2008. So, the Fed has to cut. The market is now pricing in aggressive rate cuts, not because the economy is fixed, but because the financial system is breaking. They have to cut rates too, weaken the dollar and relieve the pressure on the yen. But here's the catch. If they cut rates aggressively, while inflation is still sticky, inflation comes roaring back. We enter the stagflation era of the 1970s. Prices, low growth, and FT bond market rebels if investors refuse to buy US debt because yields are too low. The Fed will have to implement yield curve. This is the end game. This is when the central bank prints infinite money to buy its own government's debt to keep interest rates artificially low. Japan did it for 10 years. Now, the US might have to do it. When yield curve control happens, the currency is sacrificed to save the bond market. The dollar devalues. The money supply explodes. And that is the moment when hard assets decouple from paper assets. That is the moment when gold, silver, and Bitcoin stop trading like risk assets and start trading like store-of value assets. They become the assurance against the debasement of the yen. Black Swan is not a one-day event. It is a regime change. We are moving from a world of cheap leverage and stability to a world of volatility. Conclusion: the survival guide, barbell strategy, and capital scarcity. So, how do the most sophisticated institutional investors position themselves in this environment? History gives us a roadmap, often referred to as the barbell strategy. This strategy avoids the middle, the assets that are most vulnerable to inflation and volatility, and focuses on two extremes. Extreme 1, maximum safety liquidity. In a margin call, cash is oxygen. Institutional investors are holding significant portions of their portfolio in short-term US Treasury bills, TE bills. Why? Because they currently pay around 5% and they are liquid. This is the dry powder that allows them to survive the volatility and buy high-quality assets when they go on sale during a crash. It is the defensive shield extreme to maximum hard value insurance. On the other end of the barbell, smart money is accumulating assets that cannot be printed by a central bank. Gold, the historical hedge against geopolitical chaos and central bank buy-in. Silver, the industrial metal that is facing a supply squeeze. Bitcoin, the digital asset with a mathematically fixed supply. These are the assets that protect against the nuclear option, the debased currency. What are they avoiding? The middle. This includes high interest, consumer debt, margin debt, and speculative stocks with no earnings. In a world where liquidity is drying up, leverage is the enemy. The lesson from LTCM in 1998 is clear. Even the smartest models fail when leverage meets volatility. Warren Buffett is sitting on $325 billion of cash for a reason. He is not timing the market. He is waiting for the dislocation. He knows that when the carry trade fully unwinds, there will be a fire sale of world-class assets, and he wants to be the only one with the cash to buy them. Disclaimer: we are analyzing history and institutional strategy. This is not financial advice. Every investor's situation is different. Consult a professional before making any decisions. But the data is clear. The free money era is over. The hard money era has begun. The chart of USD JPY dollar yen is the most important chart in the world right now. If the line goes down, yen gets stronger. The danger is rising. If the line goes up, yen gets weaker. The bubble inflates a little longer. Keep your eyes on Tokyo. This is Finance Prism. We don't just report the news. We explain the mechanics of the machine. If this deep dive helped you connect the dots between a Japanese housewife, a crypto crash, and your portfolio, hit that subscribe button. We will keep tracking this story as the aftershocks continue. And I want to ask you a question in the comments. Do you think the Federal Reserve will choose to save the dollar, keep rates high, or save the bond market, cut rates, and print money? Type save the dollar or save the market below. Let's see what you think. I am the Strategic Director of Finance Prism. Stay liquid, stay sovereign, and watch out for the black